Welcome back to CryptosRUs. I am George. We're all George. So I'm back after 30 minutes. So the Fed decision came sooner than expected, but there is an important Q&A session that is about to start in about 7 minutes. So I want to listen to it with you guys and see what else Jerome Powell will say. But right now, we got some major volatility. Actually, I take that back. It's not major, but we did see that Bitcoin pumped up to 39,000 basically, dropped back down to about 37.6, and now we are at the same point because you know what? Everyone wants to hear what is going on. So just to get you guys updated, well, the Fed minutes came out. Basically, the decision is over. There is no official rate hike just yet. Right now, nothing has changed. Jerome Powell says come March, yes, they will most likely increase the rate, but they're still keeping a stern eye on it. And most importantly right now is what really people are waiting for is what are they going to do with the balance sheet? That is something that he did not announce yet. That is something that will be announced during this Q&A, which is coming up in about 6 minutes. So the markets are kind of iffy right now. They want to pump, but they also are cautious. So the traders are still wondering what's going on. But right now, it sounds like we are getting what we want, which is a more dovish stance on what Powell wants to do going forward in terms of rate hikes, in terms of the tapering, the balance sheet, decreasing balance sheet. It does seem like those things are coming in more dovish than hawkish right now, which is why the markets are still in the green. Bitcoin is looking like it still wants to pump. The volume exploded for a little bit, right? And the rest of the crypto market is kind of like still steady, right? Still kind of waiting to see what happens. So we got a couple more minutes. So let's strap in, or I should say strap on, and get ready for a bumpy ride. So let me get my headset and everything ready, and we will do this soon. See a lot of people very excited. Overall, this will be entertaining. One way or another, it will be entertaining. That's for sure. And it does look like Bitcoin is reacting in a good way. Right now, we're seeing the volume pick up, and a lot more volume than earlier today. So we are going the right direction. I think people are realizing this is what I said. Now, of course, maybe Powell says something that the market doesn't like, but right now it's seeming like this is turn out to be expected. A whole lot of nothing burger right now. But, when everyone was panicking the last few weeks, right, I said, the Wall Street traders are too reactive. They took the most bearish stance, which is the most hawkish stance for Jerome Powell. And, I just didn't think that, whenever everyone bets on one way, that's usually when you want to lean a little bit towards the other way, right? Now, this morning, while we're waiting, just to keep you guys updated, in case you didn't watch my stream just from like 30 minutes ago, we already have Canada that announced that they're not going to change their rates. It's still at 0.25. European Central Bank already came out and said that they're not raising rates until 2024. They're not even going to increase it in 2023. So, it goes to show you that both Canada and ECB, they're more worried about the economy right now. Still, the devastation caused by the pandemic, by COVID. So it does seem like they are taking a very dovish stand right now. But, it seems like Jerome Powell is following. right? It does seem like he's following. The overall equities market is still pretty green. NASDAQ is still pretty good. So we're looking pretty good so far. We're looking pretty good. Let me close. There's a lot of music everywhere. Let me turn this off. Pause. This music we want. Many speculated that Jerome Powell needed to also watch out for the markets, right? You can't just come out with something that totally destroy it. Oh, too loud. Okay, I turned it down. There we go. Background music. Background music. Oh man, that's really loud. Hold on. There we go. I don't know why that was so loud. I apologize. There, that's a smooth background music now. It's about to start. We're about to start here. Yeah, it's not me. I didn't turn off the music. It's just this went away here. Oh, here we go. The man of the hour. Soon. Why all of a sudden there's no sound? Hold on, sorry.
Economic activity expanded at a robust pace last year.
Okay, what about now?
Reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. For the first question, we'll go to Chris Rugaber at the Associated Press.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting. but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Okay. I'm gonna pause for a second here, because basically I need to sum up what Jerome Powell just said. Basically, no decision has been made at all. None. Zero. So he mentions a whole lot about labor force. I was trying to take some notes. The labor force, there's still a shortage. There's economic uncertainty, right? He wants to be aware and make sure that families that are struggling are not affected by inflation. So he definitely recognized that inflation is an issue, but he also recognized that inflation will also taper down as the year goes along. So a lot of, circles right there. But what we need to know ultimately is, number one is the raise on Fed fund rates, right? He did not declare exactly when it was going to happen or how much. And in terms of reducing a balance sheet, he also said it will depend on economic and financial developments, although there's no timeline on when they would do that. And about tapering in terms of in terms of what they're buying, right? I mean, all of it was basically, it's a wait and see situation. I mean, that's basically what he said. So literally everyone that was expecting him to say that, okay, we're going to raise rates 4 times this year by this much. We're going to start reducing the balance sheet by this much starting March. And we're going to do this and this and this and this. None of that was decided. Basically, Jerome Powell is saying it's a wait and see moment right now. All right, let's go back to Q&A here.
I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market, and my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timrose at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timmerhouse of the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate, we want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every 1/4 percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
This is a good question.
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations, so that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year or hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will be providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. Let's go to Gina.
Looks like Gina doesn't want to ask any questions. Hello.
Okay, let's go to Steve Leisman.
I like to ask a question.
Thank you, Mr. Clinton. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle and Chair Powell. Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing. Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of.
Real quick comment. I don't know how Chairman Powell keeps track of these questions, because these questions that go on for 5 minutes and they're talking about 10 different things. So I'm actually really impressed he could keep track of all the questions in his head.
I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. We've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. A couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to another risk is just further problems in the supply chains, which could slow down activity. And you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do an investigation, and that is out of my hands. I am playing no role in it. I seek to play no role in it, and I can't help you here today on this issue, and I'm sorry I can't.
Okay.
Thank you. We'll go to Gina now.
Hey, Gina's back.
Thanks for taking our questions, Chair Powell, and sorry for my tech issues.
She should lose her turn.
I wonder if you could tell us a little bit about where your thinking on inflation stands today. The last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to target by the end of the year. And I wonder if you still think that projection from December is a reasonable one, and if your thinking has changed at all, I wonder how you're thinking about that. And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation. Let's just go with that by a few tenths today. but we're not writing down an SEP at this meeting. But I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. That's been the pattern. So I think if you look at the FOMC participants, there's a range there, and that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension.
Everyone's asking the same questions.
So that's how we're thinking about it. As I mentioned, though, I think it's part of this will be that the Fed, moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year. And so that's another thing. The other one is we will eventually get relief on the supply side. And the ports will be cleared up, and there will be semiconductors and things like that. Now, what we're learning is it's just taking much longer. So I think longer than expected. And that, I think, does raise the risk that high inflation will be more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year. But really, the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market healthy. The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it particularly among production and non-supervisory workers and people in the lowest quartile. You see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain and that we're going to have to adapt. And we're going to communicate as clearly as we can, but we're going to have to be adaptable and move as appropriate.
Great, thank you. Thank you. Let's go to Colby Smith.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently? And should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
So, as I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just
I don't know if
regular
we're learning
retirement. So we
anything
think there
anymore.
is a pool of people out there
I'm just
who
reading
could
the
come back into
comments.
the labor
Everyone's
force.
talking about
But
Gina.
it's not
and
happening very
Colby.
quickly, and it may not. It may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the
Everyone's
March
asking
meeting
the
and
same
meetings
question.
after that.
It's just like different ways to ask the same question. He's not revealing anything else. You
Let's
notice
go to Rachel.
Jenna and Kobe has been put to the top of the Zoom chat, if you guys noticed.
Thank you, Michelle, and thank
Right
you,
here.
Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of, I think the problem that we're talking about here is really that people are on fixed incomes who are living paycheck to paycheck. They're spending most or all of their of what they're earning on food, gasoline, rent, heating, things like that,
Xboxes.
basic necessities, and
Netflix.
So inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really in prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. A high inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more so that's really how I think of it. And we have to control inflation for the benefit of all Americans.
All right. I'm going to take a real quick break from what Powell is saying. All right. So I've been taking notes, and let me recap some of the stuff I said. You guys are too much. First of all, unfortunately, Bitcoin has taken a dump after this, and the overall market has taken a dump. In fact, I don't quite understand why, because Fed Chairman Powell has just come out with the best case scenario. He has not decided anything. Nothing has been decided. So, I mean, I've been taking notes. He mentioned about how there may be another meeting or two meetings before they do any kind of balance sheet reduction. He's talking about, how fiscal policy can help with inflation, how they're going to try to improve supply chain, which could improve inflation, but he's cognizant of the labor market and making sure it's keeping strong. He wants to make sure the overall market is strong, even though he feels like the communications before has been priced in already in terms of that rate hikes. So basically, he's saying a whole lot of nothing, and there's nothing coming in March, based on what he said, because they're not going to decide anything until the next meeting, which is in February, and whatever they decide then will probably come in March, but then maybe he's going to wait until March to decide. So I don't get quite what the market is thinking, or this is just one giant fake out to kind of make people feel bearish before turning really bullish, because all the hawkish things that people were expecting, none of that came out. And we heard 1 million people ask Jerome Powell, the same question, basically different ways. And bottom line is there's no plan right now to decrease the balance sheet. They have no idea because they're looking at so many things, economic and financial situations, which they can't determine right now. In terms of the fund rate hike, they're also not making any calls. There's not guaranteed that in March things will go up, even though he's like, maybe, but again, he's looking at all this stuff that's happening. Economic and financial developments is his own words. No timeline whatsoever. Okay, so this is a whole lot of nothing being announced here, yet the markets are coming down. So is it one of those buy the rumor, sell the news kind of events? I mean, the markets aren't selling off. It's not dumping, right? Bitcoin, in fact, is still in the green. However, I don't get quite what's going on. The market should be rallying right now. He has said all the dovish stuff that many expected, yet the market is not recovering, which makes me think that there is some kind of manipulation going on across the board. And it could be one of those events where it looks very bearish right now and all of a sudden turns bullish, because it honestly, it doesn't make any sense at all. All right, let's go back to questions.
We have to protect the employment part of your mandate. Is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. I mean, if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022. And that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. Ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time
I think
is
you're right.
high
Thanks
inflation.
for the super chat, by the way.
And also, high inflation is taking away the benefits of some of these
Richard
large
says the
wage
market being
increases that we're
dumped
seeing
is
now.
dumping because of manipulation by the exchanges.
We do hope to achieve.
Yeah, but it's more than
and
that.
Our plan is to achieve both of
equities
those
market
goals.
too.
If I could follow
Deep
up,
in the red now.
does the
It
danger
makes
of
no
tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, I mean, that is what it is, but do you feel that, monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down
Steph
in large part,
argues that
including
calling
our own
manipulation
economy,
means you don't
and people going to
understand.
their homes
Markets
for
react
weeks on end in
when
masks,
there's
and
rising
there are no
hikes.
vaccines.
I understand
and
that. It's been
it could be a really
speculated
long time to
for
get them.
many months now.
And
Yet
then,
he's
and,
saying
you have
that
economic
it's not
activity
determined
drops
when
by a
it will
shocking
come,
amount.
how
in one
much.
quarter. So there was
It's
a real
still
risk
dependent
of
on economic
lasting
conditions. So
damage.
nothing has been set.
And I think
That
Congress
is why it's
responded
confusing right now. It doesn't
remarkably
make a
with
whole lot of
the
sense.
with the CARES Act, incredibly timely, very powerful. People there'll always be flaws in these things,
Those of
but
you
in
guys that are
real
mentioning
time,
Gina, you're not even spelling her name
it was a
right.
remarkable achievement, and we responded. And what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And now, what we have now is we have the strongest recovery of any country, and we have a recovery that looks completely unlike other recoveries that we've had because we've put so much support behind the recovery, and we're managing the relatively high class problems that come with that, which are high inflation and a labor shortage. So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event, and I guess.
Real quick. It's funny how you just said in 25 years we'll look back if they made the right decision, meaning going so hard into supporting the recovery, which he mentioned is the greatest right now. That's a kind of interesting perspective. Okay, real quick to answer a few super chats because people said they couldn't hear me. Number one is, all right, Axiom Music. I saw that super chat. Step, you said that, hey, calling manipulate mean you don't understand. Selling rate hikes is bad for risk assets. That's already been priced in. We've been talking about that for a few months now. Yet he's saying that he doesn't know when they will do so or how much. It all depends on economic conditions. So it's all wait and see right now. So nothing is guaranteed. And this is what we want to see in a dovish stance, right? Because there's nothing set. So it doesn't make a whole lot of sense anyways. Gio says we need direction, not kick the can down the road, right? Maybe that's the reason why. But still seems weird. Really, really weird. A dump could be related to U.S. giving Russia a written response to their demands on Ukraine. Maybe. My favorite Jerome Powell quote of the day, there are 3 types of Federal Reserve chairmen, those who can count, those who can't, and I'm in the 4th category. All right, let's get back to it.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Last question.
Hi, Chairman Powell, Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the
Look at this guy showing off his sneakers in the background and that Durant jersey.
Describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It does involve finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go. And we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much, much stronger than it was. And growth is above trend, even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy. And you asked about financials to have concerns. In connection with our policy? Was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course, have a financial stability framework. And what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated, and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector still around money market funds, although the SEC is has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable, I would say.
Thank you very much.
Thank you.
Wow, that just ended real quick right there. No parting words or anything. All right. So what did we learn from that? You know, first of all, I'd like to invite Gina onto the show, and if she accepts, I'll make sure that there's no technical difficulty there. I'm really surprised they actually gave her her question back, or put her back in line. Anyways, bottom line is this. This doesn't make a whole lot of sense to me, okay? We already know that rate hikes and everything is on the table. We expected some hawkish news about dates, the amount, right? What's going to happen with the balance sheet? How is the Fed going to handle it? Are they going to be active in terms of selling it off, or passive, just letting things expire? You know, we didn't get a whole lot of anything. I think this is a fake out. I mean, I just think this makes no sense whatsoever. We got the most dovish news from this meeting, the one that everyone pegged to be the one that will bring markets down. Yet he is saying he's cognizant of the labor market. He wants to make sure it's strong. He wants to keep it strong. He wants to make sure that other things like supply chain gets improved. He wants to make sure that financial markets are also improving, because he doesn't want that to cause people to have financial hardships. So, I mean, he's looking at everything. He's looking at everything, yet giving a whole lot of nothing in return. So this sell-off right here makes no sense at all. And I would not be surprised later today we get a huge recovery upwards and continue on, because it really makes no sense. It makes no sense whatsoever. But, you know, sometimes the market is like that, right? Sometimes the market is very, very reactive. And sometimes the market is manipulated. I mean, you know, like right now we're starting to see some green here. We're starting to see a volume. Let's see if we can just see this pump right back up. Because I think this is just a giant fake out right here. The whales making you think that this is bad news. And they want everyone to, as a last-ditch effort, to sell off before we come back up. Because based on what I just heard, I took notes. I took a lot of notes there. And there was just a whole lot of nothingness right there that was announced. So, yeah, I don't know what else to say. I mean, it's... Atema says, why does U.S. stick to money printing? Just because of COVID or because of Russia and Ukraine? They're afraid of something? I think it's more complicated than that, but they printed money to give out because they forced many businesses to close down. They forced many people to go out of work. That's why they printed so much money to give out. And also they started buying bonds from companies to make sure they don't go under. So there's a lot of reasons why, but we're kind of past that now. What is important is inflation, and that's the number one thing. And according to Powell, he thinks that inflation could be curbed through a number of means. Number one is improving supply chain, which definitely will. But that's harder because that's not in our control, right? Supply chain is all over, worldwide. China has a lot of supply chain issues, so that's going to affect consumer goods coming into the U.S. So that's harder. But then he also mentioned fiscal policy. And I was looking it up. I'm like, what does fiscal policy mean? And what is that? How does that compare to monetary policy? Well, fiscal policy could include taxes and tax breaks and how much money they're spending. So that could mean that, hey, maybe there's more tax breaks that's coming along too. So he did mention that. I'm not quite sure how fiscal policy improves inflation or will decrease it. But, you know, another thing he mentioned is, you know, in 25, he did mention that the growth, the recovery in the U.S. is faster than any country out there. And that's due to the amount of money that the Fed put into the recovery. However, he did say that in 25 years, we'll look back upon this time and determine whether or not this was the right move, because this is an unprecedented time with unprecedented printing. And you know what? This is why we're in the situation we're in, right? So you can see the greens coming in, right? This is what I was saying. This dump didn't make any sense at all. It didn't make any sense, but we'll see. The day is still young, right? Can we see a big recovery back? Sure we can. Sure we can. Can you check out? No, this is not time to check out anything on Coinbase. Basically, all the new additions recently has been junk. Bought my first BTC. It hurt me to sell some. Okay. Sean Charles released a video earlier about devastating crypto policy. Okay. There's too many people that's paying attention to what he's saying. Okay. I didn't look at it, but okay. I've been warned 100 times now. I will get to it, but it has nothing to do with what's going on right now. And whatever is being introduced probably won't be introduced for another year, because we know how the U.S. government works and there's a lot of back and forth, just like an infrastructure bill that was so feared upon. Now it's just like no one's talking about it because there's still a lot of time before it can get changed or amended. Discord API is annoying. I have no idea about that. Let's see. I mean, there's like 19,000 people in here. This is the most I've ever seen in a live stream. So thanks for tuning in. Smash it a like. Subscribe to the channel. Bottom line is, I thought that there would be this Nothing Burger conference would bring more pumps. Hey, you know what? We can still see it. We can still see it, right? Bottom line, what I've been stressing is DCA. The only sure thing when it comes to markets is DCA into the right crypto, including Bitcoin and many of the L1s and many of the others that have huge promise, right? The only thing we could be sure of is this. If you hold and you have patience, that's how you win, right? Despite the volatility, I've been stressing this, despite the fact that so many people sold off completely, claiming that the world was basically going to end financially. You know what? We got through it so far. First meeting. First meeting. We got many more to go, but this first one basically said a whole lot of nothing. A whole lot of nothing. So we just have to wait until next month to see if they say something more, because it was nothing determined. Basically, he just said all they talked about was top level stuff. All the stuff that are generalities and nothing specific. Next month, they're going to talk about it more, and then it could possibly go into the next month, which is March, and then we'll see what happens then. Okay? All right, guys, I'll let you go. Let you digest this. That was quite long Q&A, but ultimately, I think this is what we wanted. I think this is exactly what we wanted. And hopefully the fear should be dissipating after this meeting. But we will see. We will see. All right? I'll see you guys tonight. I'll have more thoughts, and everyone that keeps talking about what Charles is saying, let me take a look at what he's saying. If you know, Armageddon is coming, I don't know, but I'll take a look. All right, guys, smash the like, subscribe to the channel. I'll see you guys tonight, 8:30 p.m. Central Standard Time. Take care. Bye-bye.